Merchant cash advances often trap contractors in aggressive daily repayment cycles. Before committing your cash flow, use the payment calculator at BusinessLoan.Directory. Consider a framer who wins a significant contract in November. It's a fixed price agreement, providing certainty to the project owner. To build his bid, the framer locks in the current lumber prices on the day of signing, assuming those costs will hold until the wood is actually needed. By March, the market has shifted. The updated lumberyard quote is 17% higher than the November baseline. With a fixed contract, the owner won't pay more. The framer eats the spike, paying for materials out of his expected profit. The original bid was accurate for the day it was signed. However, static contracts in a volatile market frequently lead to this kind of margin collapse. This isn't an isolated lumber issue. Across the sector, prices for steel, copper, and PVC have moved aggressively against contractors on fixed bids. This chart shows the scale of the movement. While lumber rose 17%, steel moved 19%, and certain copper gauges climbed by 23%. Any contractor who secured their pricing months before the materials arrived on site absorbed that entire price delta. In these scenarios, project owners rarely volunteer more money, and traditional lenders offer no immediate path to bridge the gap. To survive this, many firms are turning to a material escalation line of credit, which functions as a form of inflation insurance. This line of credit remains available regardless of market volatility, providing the liquidity needed to cover the difference between the contracted bid and the actual purchase order. This vulnerability exists because most owners insist on a final, guaranteed number. As a result, many residential and small commercial contracts simply do not include a cost escalation clause. You can use the money you already earned calculator to compare the cost of absorbing a price spike against the interest rates of waiting for cheaper capital. One primary solution is Track A funding, a working capital line between $25,000 and $250,000, designed to address this specific cash flow void. The mechanic is simple. Contractors draw from the line when material purchase orders exceed the budget, then repay the balance when the next project progress draw is issued. This is the same financial product used to manage payroll, though it requires a specific use of funds memo for the lender. For larger escalations, accounts receivable financing allows a business to borrow directly against signed change orders to cover even more significant cost spikes. Used together, these tools neutralize the risk of a 17% material spike. They ensure jobs are finished and crews are paid, allowing the contractor to price future work at current market rates. Getting approved quickly requires 5 core documents: 3 months of business bank statements, last year's tax returns, a driver's license, a voided business check, and a 1-paragraph use of funds memo. That memo must explicitly state that the capital is for material cost coverage. This clarity helps underwriters move the file through the system in just a few days. Underwriters use a framework known as the 3 big C's to measure a contractor's risk against current market indices. Capacity is your cash flow relative to your debt. A debt service coverage ratio, or DSCR, above 1.25 is the standard threshold for securing prime bank rates. Capital refers to your working capital depth. Having an active credit line improves the liquidity ratios that sureties and banks prioritize when reviewing your file. Finally, character is measured by your FICO score. A score of 700 or above makes every financing category available. 650 to 699 typically routes to SBA programs, while scores below 650 lead to alternative working capital. Mastering these 3 metrics is what prevents a sudden material price spike from ending a construction business. You can see your 3 big C's live score right now by using the payment calculator at BusinessLoan.Directory. The tool is free, does not require an email for the initial score, and involves no credit check or obligation. Surviving a margin collapse isn't about outguessing the global market. It's about having the right capital ready when the market